Wall Street is not buying Ethereum the way you think it is.
So when you hear Wall Street and Ethereum in the same sentence, what pops into your head? For pretty much everyone, it's the price, right? It's all about those huge inflows, the big flashy numbers everyone's talking about. But what if that's not the real story? What if the actual takeover has almost nothing to do with just buying ETH and everything to do with completely rebuilding the financial system from the ground up? Okay, let's get into it. Okay, so picture this. It's late 2025, and this is the number you see everywhere. $13 billion. That's the total amount of money that's flowed into Ethereum ETFs. I mean, that's a massive number for sure. And you know, for most people, that's where the story ends. Wall Street's finally here. The big money is piling in. The price is going to rocket. That's it, right? Case closed. Well, not quite. See, that $13 billion figure, as huge as it is kind of like a magic trick. It's a distraction. The real Wall Street takeover, the one that really matters, isn't about just clicking buy in a brokerage account. It's happening completely behind the scenes. So what is Wall Street's real playbook? Well, here it is. It's not about buying ETH. It's about building on ETH. They're not just passive investors anymore. Nope. They are becoming the network's biggest users, wiring this technology directly into the core of their businesses. And this whole strategy really boils down to three main pillars. First up, they're tokenizing real-world assets. Think stocks, bonds, the whole shebang. Second, they're building brand new ways to move money around the globe on these rails. And third, they're earning a steady, compliant yield through staking. So let's break each of these down one by one. All right, first up, building an on-chain financial system. This is the big one. We're talking about a fundamental shift from old-school paper assets to what you could call programmable value. It's about taking trillions of dollars in traditional assets and making them digital and smart. The key idea here has a fancy name, Real-World Asset Tokenization, or RWA. But look, don't let the jargon scare you. All it really means is taking the ownership of something real, like a stock or a bond, and turning it into a digital token that lives on a blockchain, like Ethereum. Simple as that. And listen, this isn't some far-off what-if scenario. No way. This is happening right now, and it's happening at a massive scale. By the end of 2025, we're talking over $8 billion of US money market funds that were already tokenized and living on-chain. So here's the crucial thing to understand. We're not talking about JPEGs or some niche collectible here. We are talking about the absolute core plumbing of the financial system, the boring but essential multi-trillion-dollar stuff that underpins literally everything else. And if you want proof of just how serious this is, check this out. The SEC actually gave the green light, a no-action letter, to the Depository Trust Company. Now, the DTC, they're like the central hub for pretty much every single stock trade in the US. And they got the go-ahead to start testing this exact technology. The very heart of Wall Street is officially moving its plumbing on-chain. Okay, so that's the first pillar, turning assets into tokens. Now for pillar number 2, using this technology to build a completely new global settlement layer. We're talking about a new way to move money across the world. Just take a look at these numbers. It's kind of wild. Every year, stablecoins, those tokens tied to the dollar, are now settling $9 trillion in transactions. That completely blows PayPal out of the water. And it's already over half of what the entire global Visa network does. This is a silent revolution happening in plain sight. And where is this new system being built? Well, on public blockchains, with Ethereum being one of the main hubs for all this activity. And the crazy part is, the old guard isn't trying to shut it down. They're getting in on the action. Visa, MasterCard, they're both building bridges to connect to these new rails. So what happens when the world's assets and money start moving onto a network like this? Well, you have to completely rethink how you value it. It forces us to move past just speculation and hype and start thinking about real, fundamental utility. And that brings us neatly to our third pillar, institutional staking. See, for these big firms, staking Ethereum isn't like gambling on a volatile asset. It's more like owning a piece of critical infrastructure, like a toll bridge. You help secure the network, and in return, you get a cut of the revenue. It's about generating a predictable, compliant yield. And the reason they're getting so comfortable with this is because the whole system has grown up. They can do it without ever handing over their assets to someone else. They can make sure everything is compliant with regulations. The network itself is built with a safety-first mindset, and all the data is transparent. I mean, this checklist basically speaks the language of an institutional risk manager. So what does all this mean? It means we need a whole new way to think about valuing Ethereum. The old way, that was all about price speculation, social media hype, and watching those ETF numbers. The new model, the institutional one, is completely different. It's about real network revenue from fees. It's about the demand for that staking yield, and it's about the total value of all the assets being protected by the network. Now, of course, it's not all smooth sailing. This whole transformation has some major challenges, some very real risks, and you can bet the big institutions are watching these things like a hawk. They're really focused on three main things. First is something called MEV, which you can think of as a kind of hidden tax that affects a lot of transactions. Then there's the obvious one, cyber risk. We're talking billions of dollars stolen in hacks just last year. And finally, there's the regulatory mess. The rules are different everywhere you go, which is a huge headache for any global company. Which, brings us to the final and maybe the most important takeaway from all of this. When we look out to 2026, maybe the question we've all been obsessed with, what's the price of ETH going to be, is actually the wrong question. Or is the real question, how much of the global financial system is going to be rebuilt on top of this network? Because that's the metric that's really going to define its value. And that is the quiet takeover that nobody is talking about. If you're into this kind of research-driven analysis that goes a little deeper than just the price charts, make sure to subscribe. We'd love to have you.